Modern portfolio theory centers around a simple premise. It seeks to allocate portfolio assets among various asset classes so as to maximize an expected return for a given level of risk, or vice versa. To many, this strategy is known as diversification. Effective diversification means combining investments that exhibit low or negative correlation to each other, which means they don't all move up or down at the same time. One way to further diversify would be to go beyond the traditional asset classes such as equities or bonds that anchor most portfolios. Over the long term, investors with well-diversified portfolios generally have outperformed, on a risk-adjusted basis, those who pursue a more narrowly focused strategy. In fact, research shows that asset allocation accounts for more than 90% of the variability of a portfolio's returns. With proper diversification, investors have the potential to realize better risk-adjusted long-term returns. In other words, lower risk for a given level of expected return. It also offers peace of mind because it takes the emotion out of investing, and that leads to more rational decision-making. For many years, a typical balanced portfolio consisted of a 60-40% split between equity investments, for example, Canadian or U.S. equity mutual funds, and fixed income investments such as government and corporate bonds. This is mostly because these two asset classes have historically tended to react differently when the markets rise or fall. This provided a good hedge against volatility and risk, or so they thought. While the principles of this approach are still true, the formula for diversification has gone through a dramatic change. With the greater availability of different asset classes in the marketplace, optimizing a portfolio is no longer as simple as throwing together equity and fixed income investments. For example, in the equity category, we've seen the advent of international, emerging markets, small and mid-cap stocks, to name a few, and the list goes on. There are equities for just about every risk tolerance and investment style. The bond category has gone through a similar evolution. What started out as a simple choice between well-known government and corporate bonds has grown to include real return, high yield, and emerging market bonds, as well as investments like floating rate loans, just to name a few. And the list continues to grow. And then there are many non-traditional investments to consider, which, historically, have been difficult for the average investor to access. These include commercial real estate, commodities, and other niche markets. With all this choice, investors are now able to go beyond the traditional basket of equity and fixed income investments to build a well-diversified portfolio. The challenge is, where do you start? The sheer number of investments to consider is almost unmanageable, and the process of choosing complementary asset classes to achieve effective diversification is more complex than ever. Fortunately, there's a solution that allows investors to capitalize on all this choice. Invesco Intactive Portfolios. Invesco Intactive Portfolios provide investors with the edge needed to build better portfolios, as they are managed by Invesco's Global Asset Allocation team. This team diversifies the portfolios using complementary investment styles, asset classes, and geographical regions. This allows them to pull from the best equity, fixed income, and index-based solutions available through Invesco to create well-diversified portfolios that provide better risk-adjusted returns. Of course, asset class diversification is just one of the key features of the Invesco Intactive Portfolios. Get the Invesco Intactive Advantage today. It includes sophisticated portfolio construction and asset class diversification, strategic combinations of actively managed and index-based solutions, tactical management to take advantage of the near-term market opportunities, currency hedging to reduce the effects of currency fluctuations, and access to the expertise of Invesco's Global Asset Allocation team, all at a low cost to investors.